Hello, welcome to module number two, lesson number one, and today we're going to be talking about support and resistance. All right, now support and resistance are two more building blocks of technical arsenal used in price pattern analysis. A discussion of these two concepts will therefore help us greatly in our understanding of how price pattern actually works. A lot of people use the term support when they really mean resistance, and they'll use resistance when they really mean support. It's no wonder that there are a lot of confusion when it comes to this topic. Basically, these are points on a chart where the probabilities favor at least a temporary halt in the prevailing trend. So, when we look at support and resistance, what we're looking at really is a ceiling and a floor. Now, take for example, you're in an apartment complex or an apartment building, and you have your ceiling above you, and you have a few floors above, and you have floors below you. Now, your ceiling is your resistance level. Now, let's imagine that we actually broke through the ceiling. And by breaking through the ceiling, what happens is that this ceiling now becomes your floor, or it now becomes your support area. Now, on the flip side, let's say you actually break through and went to the apartment below you. Now, what was once your floor is now considered to be your ceiling. So, in Forex trading, we use the term past resistance becomes future support, and past support becomes future resistance. So that is something you guys need to keep in mind. Past support becomes future resistance, past resistance becomes future support. A support zone is a concentration of demand, and a resistance zone represents a concentration of supply. The word concentration is emphasized because supply and demand are always in balance, but it's the relative enthusiasm of buyers as compared to sellers or vice versa. That is important because that is what actually determines a trend. If buyers are more enthusiastic than sellers, they will continually increase their bids until their prices, until their purchasing demand have been satisfied. On the other hand, if sellers are more anxious, then they will be willing to liquidate at lower prices and the general price level will actually fall. Again, so not to be confused, your support is your floor, resistance is your ceiling. All right, now at the beginning, here, looking at this chart, price is declining. It finds a bottom at A, then it moves upwards. The next time it finds support at A, it rallies again until the support area is broken. So, what happens is that as the market falls and hits a level here, and one thing I want you guys to keep in mind is that the market is not random. So, whenever we see a price rejection at a level, it usually means if we look to the left or we look in the past, we're going to see reasons why the market actually stalled here. So, as the market falls and finds a support point at A and bounces back upwards, this move here is just a temporary retracement of this larger move to the downside. So, as the market hits this level once again, and remember we spoke about price having or the market having memory. So once price hits this level again, short-term traders who took the trade to to push price downwards are going to actually exit the trade, and then eventually we're going to get a breakthrough of this support level. Why? Simply because the momentum is more to the downside. So once the momentum is more to the downside, the support levels are more prone to be broken than price actually beginning to rally. Now, as the market continues going downwards, it hits another level of support again, and then it bounces briefly, and then it broke support level and finds itself at this point C. Now, once price gets into this level, here, and we can actually use other indicators to justify or basically to indicate to us that this price movement here is getting weaker. And remember also I mentioned in the first module that we have to understand where we are in the price cycle or in the trend cycle. So once price gets into this level at C, we can basically determine what's going to happen next. So at this point, we have resistance, sorry, we have support, we have support. Now, past support is likely going to become future resistance. Future resistance is likely going to become future support. So once we see price start hovering, going sideways, what we're going to be doing at this point is that we're going to start taking notice of what's going on in the market. So at this point, we can actually visualize what's going on here. And what we have to do is we're going to place a what we're going to do here, sorry, what we're going to actually do here is place a resistance level here. Therefore, once price breaks above it, it means the momentum has now shifted from the downside to now upside. And again, as we mentioned earlier, that we tend to see the market moving sideways where it's consolidating or we're getting an accumulation of bid and buy of buy and sell orders at this point, and at some point we're going to get that breakout in the market. Now if we look at a regular chart, let's see if we can find a chart here. All right, so if we look at a regular chart, what we're actually going to do now is identify resistance and support, and we're going to use a larger time frame. All right, so to find and place your resistance level or your horizontal lines, the first we're going to do is we're going to select our horizontal tool here on the platform, and we're going to look at this level as our resistance level. Why? Because this is the area where price rallied into and got rejected. So this area is an area we need to keep an eye on when price gets back into this level in the future. Okay, so next we're going to draw our support level. So we can actually look at this level as support. Now you might ask yourself, why didn't I draw this level here or draw my lines here? Now another thing to keep in mind is that support and resistance are zone areas and they are not specific price point. Therefore, we're not expecting price to hit this level of resistance and then fall, or hit this level of support and then rally. What we're looking at is a zone area where we can determine that anywhere within this zone, market is going to react and we could get a reversal in the market. So since we're drawing our resistance or support line here, what we do, we look at this entire area as a zone point. So inside here is where we're looking to find support. So to do that, we can actually even make a label on our charts. So we can actually do this, and then we can type in support, or we can actually say major support zone. Double click and drag, and then we drop it right there. And then we can go back to the draw text, and then we have major resistance. All right, so now what we have is a major resistance level and a major support level. And what we're seeing is that the market is reacting from that major resistance level. So this now becomes an area where we're looking for trading opportunities in the market. Okay. All right. So back to this chart. Now, as we anticipate price movement and we're expecting the market to actually start moving sideways, What we're actually doing now is waiting for the market to break outside of that consolidation area. So eventually, the market actually broke out, and look what happens. Market found support, market found resistance right here. It got rejected temporarily, and then it rallied once more, and then guess what? It found support here. So past resistance becoming future support. And if you guys think this is just because this is a slide, then I will actually show you one on a chart. All right, so let's head down to, let's say, the 1 hour time frame, and let's see if we can find one. Okay. All right, so here we have it. All right, so the market rallies upwards, pulls back. What do we have here? Okay, so here we had resistance. Then the market came back downwards, hit that level of support. So what was once resistance now became support. The market rallied. Market broke this high. What was resistance at one point became support. Then the market rallied, pulled back. What was once support here, or what was once resistance there, became support. The market rallied. Then the market came back downwards. What was once resistance now became support. Then eventually price failed to go higher and then trend downwards. Then guess what? Price rallied back upwards. Past resistance, past support, becoming resistance right here. And we see this every single time in the market. So it's not just because we're looking at a slide that means it doesn't happen. This is something that happens all the time in the market. So as the market begins to rally upwards, what we're expecting now, or what we're seeing now, is a shift in the momentum of the market. And one of the good thing about forex trading is that because the market repeats itself over and over and over again, we're able to anticipate price movements. So one thing we need to keep in mind, or a few things we need to keep in mind, is that previous highs and previous lows are areas where we're looking for potential trades in the market. And we'll tend to look for these previous highs and lows on your larger time frames. Now let's take a look at the anatomy of resistance and support. All right, so here, and I'm going to try and break this down to you guys as simple with and detailed as possible. Okay. All right, so first we had the market rallying upwards. Then obviously price hit a level of resistance and then created a bearish engulfing candle. So we will discuss this in the next few modules. All right, so as the price begins to trend downwards, the market hits this level here. Now, obviously, as I mentioned before, we should have had some past resistance or past support in the past. So what happened is that the market rallied upwards just a tad bit. Now, this is what happens. Now, we can actually determine a sideways movement once we see four or more candles just going sideways within a tight range. Okay? So, as the market breaks out of this range and hits this level of support here, the market pulls back into past support, becoming resistance. Then the market fell one more time and then rallied once more, trying to break back above. Because again, we're always constantly fighting between the buyers and the sellers. So, how would actually get into a trade like this is simple. So, as we see the market coming downwards, we don't want to get into a trade here. This area is an area of thin liquidity, but at the same time, we don't want to get into a trade here because we're literally jumping onto a moving train. So, what we want to do is we want to see the market pause for a minute and then pull back. So, here we had that minor pause in price. Now, bear in mind that in order for price to fall all the way down here, there had to be some momentum in the market that pushed price downwards. So, based off this information, we're definitely bearish. So what we're doing now is we're simply waiting for the right opportunity to get into these trades. So as the market started going sideways, just like it did here, we're now waiting for price to break outside of this range, boom, to the downside. So as the market came down and then pulled back into past support, becoming resistance, this area becomes your new area where you could actually get into the trade. And we could actually keep our stop losses outside of this swing high. So what we're doing actually is we're waiting until price actually build up some momentum, break through, pulls back, and that's when we get into a trade to go short. And our stop loss is outside of here because at the same time, we don't want to get stopped out only to see the market continue going in our direction. So the market kind of went sideways for a while, made one last spike upwards back into this area of resistance, and then fell off. Market came down, found support here, and then rallied back upwards again. Past support becoming resistance right here. Then market came down, hitting this level of support, made one final spike up to the resistance level here, got rejected, and then sold off to here. Now, we could not determine if price was going to continue going downwards or is going to reverse unless we had some other indicator that says this move to the downside is getting exhausted, right? So let's anticipate, or let's just for the sake of this presentation, let's say we had another indicator that indicated to us that this move to the downside was getting exhausted and we're now looking for price to continue going upwards. So how would we actually trade this market to the upside? Now, the first we want to determine is where our support and resistance are. So we have support here, we have resistance and support here, and we're seeing a turn in the market. So if price was going to continue going downwards, the first thing that would happen is that price would actually would have gotten rejected here and then fell lower. Instead, price actually broke above this level of resistance, hitting this level of resistance. So that means momentum pushed price into these levels here. So basically, the conviction of the market right now is to the upside. Traders are now looking to buy. So at that point, once we see that price movement pushing price upwards into these levels of resistance, now our trading opportunity comes when the market pulls back into a level of support. So past resistance now becoming support. We would have gotten into a trade here with our stop loss below these lows, and then we'll be exiting the trade at another area of resistance and support in the market. So we can actually look at these levels as past support, which eventually is going to become resistance. Market got rejected here. So what we're actually doing is we're simply timing the market and waiting for the opportunity to arise before actually getting into these trades. And we're not going to get into trades based off whim, based off just the feeling of it. We want to see that price is actually moving upwards. We want to see that the momentum has shifted from the downside and is now moving to the upside. And this price movement here gives us that clue because if price was going to keep going downwards, it should not have broken back above this level. And if it did, it certainly should not have broken back above this level. However, the market actually did hit this level of resistance and then sold off. So just like in the previous lessons that we did, where the market rallies up, pulls back, simply because we have traders who exits their trade at this level of resistance and then look for other opportunity to get back into the market at a later date. Then the market rallied up, pull back down, continue going higher. And guess what? It stalled right here at resistance. So if we just simply look at one chart or just one or two charts, we can actually make money by just following these price movements. And it's not difficult to do, guys. It's very simple, but it requires a lot of practice. And once we practice enough and once we start seeing these patterns developing and emerging in front of our eyes, then we're going to start gaining the confidence that we need to trade more effectively and with confidence. So next rule is our rounded numbers. Support and resistance zones have a habit of forming at rounded numbers. Now, these rounded numbers are considered to be psychological levels because these are levels that the institutional traders they look at these levels. And we don't look at these levels in isolation either. We look at these levels in conjunction with other indicators on our chart. So, if we're looking at, let's say, this level here, let me get my drawing tool. If we're looking at, say, this level here, and it's actually in line with a rounded number, let's say 1.600, then this area becomes a very strong level of support. Simply because everybody else is actually looking at this level and everyone else is willing to purchase at this level. So, one thing we have to do when we're looking to trade is we have to determine to ourselves and ask ourselves the question: am I willing to buy at this price? And if I buy at this price, is there somebody else willing to buy at a worse price than I did? So that's one of the questions we need to ask ourselves. Am I willing to buy? Am I comfortable in buying here? And will there be somebody else that is willing to buy at a price higher than I have bought to push price upwards? Now, if we're at this level and we're looking to buy, then guys, that would be crazy because we're at a resistance level. And at this point, basically, no one is actually willing to purchase above this level. So, with our little money that we have in our accounts, there's no way we can actually push price higher, right? So, we have to now wait and see what's going on with the market before we can execute our trades at this price if we're looking to go long. Now, if price pulls back into this level of, let's say, past resistance now becoming support, then this area becomes a good trading area to actually push price higher. So, while all we need to do on a day by day basis is dissect the market. That's all we need to do. Dissect the market because the market always gives us clues as to what it's going to do. Trend lines and moving averages represents levels of support and resistance also. Now, a good trend line represents a resistance area in a downtrend and also represents a support in an uptrend. Now, one of the things that I've noticed over the years of trading, again, is that traders tend to force trades. And there's a correct way of drawing your trend lines and there's an incorrect way of drawing your trend lines. Now, to draw your trend lines effectively, what we're looking to do is locating the highest point on a chart and then connecting the lower high of that chart, which would be here, and then we have the line extended into the future. So, looking at a typical chart here, let's see, we go to the draw trend line tool, and let's say this is what we were looking at. So, we simply place our mouse above here, left click and hold, and drag down to that level. So this area now becomes your resistance levels. And then once that level is broken, then we're now looking to trade to the upside. So to draw your trend lines is very effective if you draw your trend line correctly. So draw a trend line tool, and we're looking for the lowest point on the chart. Let's say here. Then we're going to drag to there, release. That's your resistance. That's your support level. And as the market begins to trend with more extreme force to the upside, we can also draw new trend lines. There we go. And same like our resistance and support levels. Past support become future resistance, past resistance become future support. And you would be surprised to know how effective these lines are in the near future. All right, so support and resistance represents a concentration of demand and supply sufficient enough to halt price move, at least temporary. Now, these are not signals to buy nor sell, but rather intelligent places for anticipating reversals. And they should always be used in conjunction with other indicators. Potential support and resistance zone develop at previous highs, previous lows, rounded numbers, trend lines, and moving averages. All right, so let's take a look at trend lines much more closer. A trend line is a straight line connecting a series of ascending bottoms in a rising market or the tops of a descending series of rally peaks. So, when we're drawing our trend lines, as I mentioned earlier, is that we're looking for the peak, we're looking for the first peak or the highest point on the chart, and we're connecting the second peak of that chart and then have the market or have the line extends into the future. So this now actually represents your resistance level. Now there is a correct way and an incorrect way of drawing your trend lines. This is your incorrect way of drawing your trend lines. This also is your incorrect way of drawing your trend lines. Now, can you actually look and tell me what the difference is? And I'll give you guys a few seconds. All right, I think you got it. Now, notice the line itself did not connect with the body of the chart, of the candles. And also with this diagram, we only connected one line here, and that was it. Now, of course, as I said, we want to ensure that the line is connected to the following low point here. So that's your high, that's your lower high. The line extends into the future. All right, so here we're looking at typical market price movement. So the market came down, found support, and started rallying upwards. So as the market rallies upwards and creates a higher high or a higher low here, then we can simply draw our trend lines. So this trend line now becomes an area of trading opportunity also because it is still an area of resistance, sorry, of support. So once price gets into this level, then we are actually looking for trade signals to go long, or if it breaks to the downside, we're looking for reasons to go short. Now, there are going to be times when the market will make an extreme move to the upside. And when that happens, then we can actually look to draw a secondary trend line to follow the market going upwards. So even if or even when price actually breaks back below this level, it does not simply mean that we have now shifted back to the downside because we still have this area as our primary trend line. So what this actually does is that when price breaks below the secondary trend line, it basically just triggers or trickles down into the primary trend line. And then at this level, this is where we're now looking for trading opportunities in the market. So the completion of a price pattern can signify either one, a reversal in the previous trend, which is known as a reversal pattern, or two, a resumption of the previous trend, which is called a consolidation or a continuation pattern. Now, As the market rallies and breaks this level of support, and this again is where we spoke about price movements in module number one. So as continues to rally upwards within a pattern, we then see that price breaks this low point. So at this point, at this break here of support, we're now looking for opportunity to sell once price pulls back into into a area of resistance. And this basically turns into what, guys? A head and shoulder pattern. Correct. So here we have the left tip, we have the head, and we have a right tip. So this basically gives us a head and shoulder pattern. Now, of course, let me do this. Now, of course, there can be times when the market just moves sideways in terms of consolidating within a range and continue moving higher. So this basically is considered to be a continuation pattern. And this is why it's important that we look for added confirmation when we're looking to trade. So as the market rallies upwards within that trend, boom, breaks that level of support there, rallies upwards, hit that level of resistance. This is where we'd be looking to trade to go long, or sorry, to go short or to sell into the market. Now, using other indicators such as your MACD or your stochastic or even your RSI indicator, you can actually filter bad trades out. And another thing that we use in the event that we're wrong is our stop losses. So if we had gotten into a trade here, our stop loss would have been here, which means as the market continues to do this and then breaks out, we're out of that trade. And then at that point, we're now looking for reasons to now go long in the market. So we're actually following the continuation of the trend. Here we see the market made a reversal. So the market rallied upwards, it consolidated for a while, and then boom, the market sold off to the downside. So again, once we get that break in a pattern, that's basically when we're looking for some level of confirmation to say, okay, we're going up or no, price is going down. And also, we want to trade in the direction of your larger time frame. So remember we spoke about primary trend lines, okay? Our primary trend. So we want to trade in the direction of your primary trend. So let's take a look at an example. Now let's say the market was going downwards on your larger time frame. So this is your daily chart trending downwards. Then the market pulled back. So this pullback here is what we're seeing here on your smaller time frame. Then as the market gets into this level of resistance on your larger time frame, it starts going sideways, right? So we're seeing that level of consolidation here. And then boom, the market sold off. Why? Because price tends to follow the direction of your primary trend. So when we're looking to trade, these are some of the clues that we can look at to determine what direction we're looking to trade in. So when we look at a larger time frame, when we look at a daily chart and we see price going downwards, on your smaller time frame, you're not looking to buy. You're looking for reasons to sell on your smaller time frame and vice versa. So it's important to keep abreast of your daily time frame. Now, as we apply our trend line, what was once support will eventually become resistance in the future. So again, once we see a break of a support level and the market starts rallying back upwards, this said area of support can then become your resistance level. And what we're seeing here is a typical double top pattern. So the market came down, rallied back upwards, made one final attempt to break this high, and then boom, price sold off to the downside. And same thing applies in a downtrend. Market came down, we drew this trend line to the downside, past resistance, finally became support, then the market bounced and started rallying back upwards. Now let's look at a few examples. All right, so here we have a typical chart, and notice price started trending upwards. Boom, so we connected this low to a lower high, and then the market started trailing upwards. It pulls back into this level of resist of support. Market rallies higher, pulls back into this level of support. Then finally, price actually broke through that level of support. Past support then became future resistance. Here, we start seeing the market moving sideways. So you can actually look now to determine which direction you would be looking to trade. Now, let's say we're on the daily time frame, on the larger time frame, we're in an uptrend. So if we're in an uptrend, what are we doing? What are we looking to do? We'll be looking to buy once price breaks out of this area of resistance. If we were in a downtrend, we'd be looking for a break of a support level to go lower in the market. So it all depends on what your daily time frame is actually telling you, because you want to trade in the direction of your larger time frame at all times. Here again, we have the market creating a nice peak. Then we draw a trend line connecting these lows to the downside. Now, as the market came down, rallied back upwards, broke that level of resistance, came back down, past resistance, became support. The market hovered for a while and then it started trading higher. So, a lot of traders will use trend lines as a standalone signal to get into trades, because what they're saying is that as long as price is below a major trend, they're in a downtrend. And as long as price breaks above and is trading above a major trend line, then they're in an uptrend. So, it's all a matter of perspective and how you want to trade, because every single one of us are unique individuals with our own perspective of the market. So, significance of a trend line. It has been established that a break in trend caused by penetration of a trend line results in either an actual trend reversal or a slowing in the pace of the trend. Although it may not always be possible to determine which of these alternatives will develop, it is still important to understand the significance of a trend line penetration. A trend line measures a trend, so the longer the trend line, the longer the trend it is monitoring, and the more significant the trend line is. So, the longer the trend line is, or the longer the trend is, the more solid, the more valid that trend becomes, or that trend line becomes. The number of times the trend line has been touched or approached. The trend line strength is based on the number of times it has been touched over and over and over again. The larger the number, the greater the trend line significance. And what I mean by that is, as the market rallies and hits a level of support, the more times this line holds as support, the stronger this line becomes. And when this line actually breaks, boom, and pulls back, it becomes even stronger. Same thing for your resistance and support levels. As the market creates a resistance and breaks through, it acts as support. And as the market breaks back through, it acts as resistance. So the more times we see price reacting at a specific price point or within a zone area, that area becomes a solid level of resistance and support. So when we're looking to identify key areas in the market, what we're looking for are multiple bounces at a specific price point. That's basically what we're looking for. Multiple bounces at a specific price point. All right, so trade and resistance and support, the bounce. All right, so as the name suggests, when price gets into a level of support, we're looking for a bounce in the market. And what we tend to want to do is we want to wait for some bullish confirmation here before actually getting into a trade. So looking at this diagram, as the market fell lower, making lower highs and lower lows. Once price gets into this level of resist of support, look what's actually happening. We start seeing the market tapering off here, creating what we call indecision candles. And then the market actually made a turn to the upside with this strong bullish candle here. We got a retracement or we got a retest of this said low area, and then the market started trading upwards. So, how would we actually look to trade this? Now, remember, I mentioned to you guys before that when we're looking to trade and when we're looking to anticipate price movement, we don't want to get in on a trade on the first move to the upside. We want to get in on a pullback into the market. So, as price came down, hit this level of support, rallied up for the first time. Here is where we're looking for trading opportunities, and where exactly would we be keeping our stop loss? Exactly, we would be keeping our stop losses below the support area. So the market rallied up, hit that level of resistance, came back down, hit that level of support, creating a double bottom pattern, and then boom, the market started to rally upwards. So what happened is that instead of getting in on a trade here and then experiencing all this pullback in the market, we want to get in, as I said, we're trying to be precise when it comes to trading, and we're not always going to get it correct, or we're not always going to be precise or exact. But if we stick to our strategy over and over and over again, this strategy plays itself out at all times. So not on the first rally upwards are we looking to get into a trade. We're looking to get into a trade on a pullback. And, as an individual trader, you can actually look to say, okay, this is my criteria in getting into a trade. And my criteria is whenever price rallies upwards, whenever I see a move to the downside, and I'm convinced that this area is a support area, and price rallies upwards, then I am not getting into a trade until I get a pullback into this support area. So that's one filter you can use to get into your trades. Another filter is saying, okay, I'm not going to get in here. I'm not going to get in on a pullback, but I will get into the trade when price now breaks this level of resistance. So basically, what you would have done at this point is basically sit this out until price eventually breaks above that level of resistance. Then and only then will you be actually looking to get into your trade. So this can actually be a criteria for you to filter out your trades or filter out your bad trades. So as I said, I'm not looking to teach you guys a specific strategy. I will teach you my strategy, but not to teach you my strategy and say, okay, go fish. I'm teaching you how to interpret the market, how to anticipate price movement to become better traders, and using my strategy as a guideline to create and develop your own strategy in the market. Because what happened is that when it comes to trading, again, it's a matter of being consistent at all times. And what works for me may not work for you. What works for you will not work for another person. So, what happened is that there's some fundamental basics in forex trading that we go by, and once that is applied, or once we've achieved those basic fundamentals, then it's up to us to build on that to create our own edge in the market, to develop our own strategy that suits us at all times. So, I'm not telling you guys trade like I do, but what I'm doing is I am giving you guys different strategies in how to actually approach the market at all times. All right, so here we have another bounce in a downtrend. So as the market continues to trend downwards, now how would we actually look to trade this? Simple. As the market comes down, hits this level of resistance here. Of course, we have the trend line now extended into the future. Now, as the market falls, we actually see past support becoming resistance. So once price get into this level, what's happening now is that we have a confluence. Now, confluence is where two or more indicators actually meet at that point. So we have our downtrend line and we have our past support area both converging right here. So this level now becomes a strong area of resistance in the market. And this is where you'd actually go short. So we go short when price breaks the low, breaks this support area, then pulls back into the trend line, into the back end of this past support, becoming resistance horizontal line. Then market begins to fall. Market pulls back, then it continues falling, pulls back into this level of support, into this level of resistance, and then fell. And look what happens. Market broke the support level and then pulls back into past support, becoming resistance. Again, another entry point to go short in the market. Here we have market breaking support, pulls back another area to get into the market to go lower. Look what happens here. Market breaks support, pulls back into resistance right here into the back end of the trend line to go lower. Guys, it's not that difficult to trade the market. You just need confidence and you have to believe in something. It's almost like if you're going to go from A to Z, you're not going to be thinking, okay, I'm going to run out of gas, or I'm going to get a flat, or somebody's going to rear end me. You're confident that you're going to go in your vehicle and you're going to move from point A to point B safely. It's the same thing with Forex. Once we have the groundwork all taken care of, it's just a matter of getting from point A to B safely. And whatever happens in between, it's something that we're prepared for. Because at the end of the day, Forex trading should not be stressful. It should be something fun and relaxing. And easier said than done. But I have to admit it's actually easier said than done. But if we have all the fundamentals within us and we practice enough, guys, we can become proficient traders. And all it takes is practice. All right, so let's move on. All right, so the break, and I know a lot of guys likes to trade the break off a resistance and support area. So again, we want to ensure that we're tying our trades with our larger time frames. So in this scenario, we're seeing where price rallied up, creating a resistance level. Then, as the market rallies, comes back down, boom, hits that support level once more. Look what happened here. Market rallies up, came back down, hit that support level. Well, didn't hit that support level, sorry. Did not hit that support level. Rallied up tad bit, then finally broke this support level, hitting this past resistance, now becoming support. Then the market rallied back upwards. Where did it stop? Right at your resistance level, right there. Then the market came back down, hit that said level of support, rallied back upwards again, and then boom, finally it broke through. So I want to ask you guys, how many of you would actually sit and wait until price actually breaks below here to get into a trade? Not many. Not many. So it all boils down to being patient and confident in your analysis. Now, in this scenario, there is actually a way to get into your trade before here. And I'm going to give you guys a minute to actually look at this. Okay. So what happened is that we've already identified some turning points in the market. We have that area as a low point. Now the market came down, hit that level of support, then rallied up a tad bit, came down, hit that level of support here. Past support, past resistance, becoming support. So on a pullback inside this level of resistance, that's your entry to go short right there because price broke this level of resistance. Sorry, this level of support. Price broke this level of support coming downwards. Now we're getting that pullback into the market. So you could have actually gone into your trade here with your stop loss above these highs to take the trade lower. Now, here is something else that I want you guys to take note of. This move to the downside and this pullback here, this pullback is not a valid high. Reason being, it did not break this low point. This swing did not break this low. So what we want to do is we want to smooth out the market and then do this. Then on a pullback, that's your entry to go short. And what are we seeing here? Left shoulder, head, right shoulder, head and shoulder pattern. Break off a neckline, that's your entry to go short. So there are multiple ways in actually executing your trades as long as you have an idea as to how the market works. So in this scenario, we're looking to get in on a trade when price breaks this support area here. So on the break itself, there are two ways in actually getting in on this trade, on this break. One, you could get in on the break here and the close of the candle. So we get into the trade expecting the market to go lower with our stop loss above these highs. Because remember, we want to keep our stop losses outside of these swing points. Because as long as we're in a downtrend, price should not rally back above these highs. So as long as this swing breaks this low, this area becomes a solid level of resistance. So worst thing that can happen is that we get a pullback into this level, retesting these highs for the market to go lower. So here we get into the trade when price breaks and closes below the support line. Now another thing to keep note of, to take note of, is I know a lot of you guys would like to get into these trades when you see the market break. But as long as this candle is live, we are not sure or certain that this is actually going to close as a bearish candle. Because what will tend to happen is that the market will actually break that support level. And just minutes before the hour closes, or whatever time frame you're trading on, boom, the market starts trading back upwards. And you get stuck with a loss. So we want to ensure that when we're looking for a break of a support or resistance level, we want to see the market, the candle actually closes below or above that level of resistance and support. Now, the second way of getting into this trade is now on a pullback. Now, your pullback is basically a more better risk to reward ratio when we actually wait on a pullback into the market. Now, look at the difference here. Now, let's say we got into the trade here with your stop loss above here. And let's say your take profit was going to be here. This is the length of your stop loss. This is the length of your profit. Now, look at the pullback. If we wait until we get a pullback into past support, becoming resistance, we've just actually reduced our risk in the market, and we've just expanded our profit. So it's better to actually wait on a pullback than actually getting in on that close of the candle. The only drawback, the only con in this scenario is that price could just simply break through, and continue trading downwards. And if that happens, guys, we just simply stay out of the trade and wait for another mark and wait for another trade to appear. Simple. All right. Now here, past support becoming resistance. So as the market actually consolidates here, so it's building up a nice base, then price broke out to the upside, and then boom, market started trading downwards, breaking that level of support. Could have gone in on that move to the downside, but price came back up, retested these highs, or retested this resistance level, and then sold off. Now, NFP stands for non-farm payroll. Non-farm payroll happens every first Friday of every month. And this news release, which happens at 8:30 in the mornings, usually follows with volatility in the market. So in a space of, let's say, 2 hours, the market probably could have fell over 200 or to over 100 pips. All right, so the next lesson we will be looking at the MACD. I will be explaining the MACD and actually going over some live examples or past examples, sorry, with the MACD and showing you exactly how I personally trade the MACD with resistance and support levels to find high probability trades. So until next time, enjoy the rest of your day or your night, and I'll see you soon.